Hello, listeners. Welcome to the Morning Market Update, the podcast powered by AI. I'm Joe.
And I'm Sarah. Today is February 6th, 2026. Let's dive in. We are starting with a heavy dose of volatility in the U.S. markets this morning. It has been a sea of pain for tech investors as the Nasdaq continues to grapple with a deepening sell-off. The primary catalyst is a massive reality check on artificial intelligence spending. Amazon is leading the retreat, with its shares sliding about 8% after announcing a staggering $200 billion capital expenditure plan for 2026. When you add that to the projected spending from Alphabet, Meta, and Microsoft, we're looking at a $650 billion AI arms race this year alone. Investors are beginning to ask, when does the payback start? The S&P 500 is feeling the weight of that tech drag, though the Dow Jones Industrial Average has shown some relative resilience, actually rebounding slightly in the most recent session as investors rotate into value. Small caps via the Russell 2000 are struggling as well, down as the broader risk-off sentiment takes hold. Meanwhile, the crypto space has been a roller coaster. Bitcoin saw a flash crash toward the $60,000 mark, its worst one-day drawdown since the FTX collapse, before buyers stepped in to push it back towards $65,000. It's a jittery morning on Wall Street, with the dip buyers battling bubble fears in real time.
Moving north to the 49th parallel, the TSX in Canada is facing its own set of headwinds today. The Canadian benchmark is heavily weighted toward energy and materials, both of which are seeing significant movement. Oil prices have been wavering as we track the indirect talks between the U.S. and Iran and Oman. Brent has been hovering around $68 a barrel with WTI at $64, and that uncertainty is keeping a lid on the big Canadian producers like Suncor and Canadian Natural Resources. We're also seeing a spillover effect in the mining sector. With the massive volatility in Bitcoin, Canadian-listed crypto miners like IREN and CleanSpark have seen their shares plunge as earnings fall short of expectations. On the brighter side, we are seeing some stability in the financial sector. Much like their peers on Wall Street, the big Canadian banks are looking at a banner year for deal-making, which might provide a cushion for the TSX today. However, the overarching theme in Toronto this morning is caution, as the wealth effect rotation we're seeing in the U.S. hasn't quite sparked a rally in the Canadian resource heavyweights just yet.
Looking across the oceans, the picture doesn't get much prettier. In Europe, the FTSE 100, DAX, and CAC 40 are all under pressure. The automotive sector is in a full-blown crisis mode this morning. Stellantis saw its shares crater by 14% at the open after announcing billions in charges, while Volvo Cars recorded its biggest slump on record in Stockholm. A toxic blend of higher U.S. tariffs, fading EV subsidies, and a price war in China is hammering European manufacturing. Over in Asia, the Nikkei followed the Nasdaq's lead, closing lower as tech sentiment soured globally. In India, the Nifty 50 is facing pressure as well. Indian bonds declined after the Reserve Bank of India refrained from fresh debt purchases in its latest policy decision. Traders were hoping for liquidity measures to offset record government borrowing, and the lack of action has left the rupee and Indian equities vulnerable. In the currency markets, the euro is holding steady despite the market carnage, with ECB officials indicating they aren't alarmed by the currency's recent rally, though they are watching it closely.
Let's get into the big corporate stories in North America. We have to start with Amazon's $200 billion bombshell. It's not just the size of the spend, it's the miss on earnings that has the market spooked. Analysts expected $146 billion in CapEx, so that $200 billion figure is a massive escalation. But it's not all red on the screen. Roblox is the hero of the morning, with shares skyrocketing 20% after a massive earnings beat and a very optimistic forecast for the year ahead. It seems the metaverse isn't dead for everyone. In the retail space, Estée Lauder is giving us a grim preview of the tariff era. The company warned of a $100 million hit to its full-year profitability due to new trade barriers, sending its stock down over 20%. On a more localized note, Bob's Discount Furniture made its NYSE debut, closing flat after pricing at $17 a share. And in the pharmaceutical world, Bristol Myers is proving to be a safe haven. Analysts just raised their price targets there after a strong earnings beat, making it a rare outperformer in this high-growth sell-off.
Shifting to international corporate news, the Stellantis shock is the talk of the European bourses. The 14% drop is a massive blow for the carmaker as it tries to navigate a transition to electric vehicles that is proving more expensive than anyone anticipated. Volvo is in a similar boat, reporting an EBIT margin of just 2%. It's a reminder that the global auto industry is currently caught between a rock and a hard place. In Germany, the defense giant Rheinmetall is seeing its halo slip. After being a top performer for 2 years, confusion over accounting changes has led to a bout of profit-taking. Meanwhile, in Japan, Metaplanet, often called the MicroStrategy of Asia, is doubling down. Despite the brutal drawdown in the crypto markets, their CEO Simon Jarovich vowed to keep buying Bitcoin. And finally, keep an eye on the software sector globally. We're seeing a SaaS apocalypse narrative forming as new AI tools from major tech firms threaten the traditional subscription software model, leading to what some call a logical panic and others call a fundamental shift in value.
Turning to the big picture of economics and geopolitics, the talk of the town is the expected shift at the Federal Reserve. With Kevin Warsh tipped as the next Fed chair, the market is pricing in a more dovish stance than we saw under Jerome Powell. This is acting as a bit of a counterweight to the tech gloom, as lower rates generally help valuations. However, we have a major U.S. jobs report looming next week that will be the real test. On the geopolitical front, all eyes are on Oman. The indirect talks between the U.S. and Iran are a double-edged sword for markets. While de-escalation is good for global stability, Tehran is signaling that these will be prolonged negotiations. This has dashed hopes for a quick resolution, which is why we're seeing oil prices bounce around so much this morning. Traders are essentially in a wait-and-see mode regarding the Middle East risk premium.
To wrap things up for our listeners, here are the key takeaways for today, February 6th. First, the AI spend fatigue is real. When companies like Amazon spend $200 billion, investors want to see immediate margin expansion, not just future promises. Second, the tariff hit is no longer theoretical. Estée Lauder's 20% drop shows that trade policy is now a direct line item risk for multinational corporations. Third, the crypto market is in a high-stakes stress test. Bitcoin's ability to hold the $60,000 level will be a major signal for risk appetite throughout the day. And finally, the automotive sector in Europe is flashing red. If you're invested in global manufacturing, the earnings misses from Volvo and Stellantis are a loud warning bell about weakening global demand and rising costs.
That wraps up today's update. I hope you gained useful insights into the pre-market action.
Add your thoughts in the comments and follow for more such updates. This is Sarah
And Joe, signing off.